Hi everyone and welcome to Real Estate Investing in Canada. The objective of this course is to help you make investments in real estate in the most efficient way. Okay. So if you're watching this on YouTube, please subscribe and activate the notifications if you like videos like this. Our channel is EduFin Wizards on YouTube. You can also get access to the complete course on Udemy and Skillshare. Not all videos on YouTube are for free. Like there are a lot of other videos that you can get access to on Udemy or Skillshare. The links are in the description. Okay. So let's start. So today we are going to discuss about the topic of home equity. So what is home equity? Home equity is the amount that is left in your house after paying off your mortgage. So once again, amount that is left in your house after paying all the debt on it. So like example, let's say the value of your house is $100,000 now and your mortgage is $40,000. So difference between that 100,000 and 40,000, that is 60,000, is your home equity. So difference between the value of your house and the mortgage on it becomes home equity. Now you might want to access this home equity. So how do you access this home equity? Right? So the first option is you can go for selling the property. So you can sell that house for $100,000, pay off the mortgage of $40,000 and get $60,000 of home equity. Now, what are the reasons why you would want to sell the property? So typically home equity is accessed when you downscale. And this is very popular in Canada. A lot of Canadians do it. So what do Canadians do? When they are young, they start with an apartment. Okay. Then as their family grows, they sell that apartment and buy a house. So let's say you bought a $400,000 apartment, you sold it few years in, let's say 10 years in, right, for let's say 600,000, right? So you access some home equity, you got that home equity and bought a new house, like a bigger house with backyards and everything. Now you went through life and you are empty nester. Now you're nearing retirement. So in retirement, people generally downscale. So what will happen? They have this, let's say a $2 million house now after 35 years of real estate growth, and they don't have any mortgage on it because they have paid off the mortgage in the last 30 years or so. So what will they do now? They will sell that $2 million house, access that home equity of 2 million, right? Because there is no mortgage. So home equity is $2 million and they will buy something cheaper. Let's say an apartment again for 500,000. So this is called as downscaling. So you buy up in your life till retirement and you buy down in your life after retirement. So this is one of the very common ways of accessing home equity. Now, when you sell your property, you generally have to pay real estate commissions. It's generally somewhere between 3 to 7% depending on the province and depending on the deal you're getting. So that's one of the pain points. And also you need to find another place to live. So you might not want to scale down if you love your house, right? If you have a neighborhood that you like to live in, if you have all the amenities that you like within certain distance, you like that. So you don't want to downscale. Not everyone wants to downscale. So that's a big hurdle. So how can you access home equity without selling? So there are ways to do that using a bank. So there are home equity line of credits called as HELOC loans. There is second mortgage and there is reverse mortgage. So in the next few slides, we are going to discuss about how to access home equity without even selling. So first is home equity line of credit. So the rule is you can borrow up to 80% of value of your home that is found out by independent assessment by the bank. So the bank will send in agents like real estate companies and they will access your house. How much is the home value? And as you pay down your mortgage, you access more home equity through the line of credit portion of the plan. So how does it work? You have a house, let's say 525,000. The mortgage remaining on that is $380,000. So this home value is found out by the bank independently. It doesn't depend on what you tell them. So 525 is the house value, 380 is the mortgage. You can access 80% of the house value. So 80% of house value, 525,000 minus into 80% minus the mortgage. So 525,000 into 80% of it minus the mortgage 380 on it gives you the HELOC amount. So you can access $40,000 as a line of credit. Now it is a line of credit, so it will be available to you. Whatever you use in that amount, then you have to pay interest on that. Interest is generally on the lower side than personal line of credits. So HELOC loans are very important if you want to create an emergency fund for yourself, rather than having personal line of credit on which the interest rates are way higher. You can have a home equity line of credit that gives you access to like cash, immediate cash in case there is an emergency. How do we access it? 80% of the house value minus the mortgage will give you the HELOC amount. Okay, the current HELOC rate, it will change. So right now the HELOC rates from Tangerine are 4.6%, from Motors Bank 5.2%, Scotia Bank is around 5.2, TD is around 5.22. So home, like personal line of credit right now is around 7 to 8% depending on your credit score, but HELOC loans are way cheaper than personal lines of credit because banks has a safety of your house that is kept as a collateral. So that is the reason home equity line of credits are like relatively cheap. Now as a financial planner, how do people use home equity lines of credit? They use home equity lines of credit for emergency funds, of course, like have some safety net, have a line of credit. You don't want to use it, but just it is there in case something goes wrong, right? They use home equity line of credit for renovations, for big purchases. They use home equity line of credit for down payment on second property. That also is a way of using home equity in your house. Then the second concept is you can also access the home equity in your property by something called as a reverse mortgage. So what is a reverse mortgage? In Canada, a reverse mortgage is a type of loan that is secured against your principal residence. The financing solution gives you access to cash, tax-free cash with no mandatory ongoing payments. So lines of credit, you have some payments that you have to keep on making, but in a reverse mortgage, they give access to you of cash either in lump sum form or in monthly form, and you don't have to make any payments on it, right? So how does it work? So I'm a retired couple. Say my age is, let's say, 65, my wife's age is 67. So we have a house and we want some monthly pension coming from that house. So we'll go to a bank, we'll say we want to do a reverse mortgage on our house. So bank will do some calculations based on the value of your house, value of your mortgage. They will extend to you two options, either a lump sum amount that you can take or a monthly amount that they will extend it to you, right? Now if you like take a monthly amount, let's say $200-300 of monthly pension, so you keep on consuming that pension, right? You live in the house still belongs to you, right? The title is just registered, like there is a reverse mortgage on your title. That's the only change. You get access to your property, you keep on living in it, like, and the rule is, and like if you're alive and your spouse is alive, you can live in it. If one of you passes away, the spouse can still access the property. But when the spouse passes away, right, there is no title holder that is alive right now, then the house, right, the reverse mortgage on it has to be paid back. So it generally comes from the estate proceeds. So when the person passes away, the estate proceeds of him or her will be paying that reverse mortgage. So you do not have to worry about paying that reverse mortgage on your house until you're alive, right? Also, there is a condition: if you sell the house, then you have to pay it. If you're not selling the house, you can get access to it, live in that house, get a monthly pension or get a lump sum amount, use that money, but you don't have to pay it back until you're alive. It will keep on creating interest, it will keep on growing, of course, but once the title holder passes away, right, then the amount becomes due. Either it is collected generally from the estate, like once you sell the house, once the nominees of your property, like of your estate, sell that house, the bank will collect that amount from them, Okay, so this is a very innovative and very useful tool if you're struggling to survive, if your budget is not stretching by, like say you're short of $200-300 a month, you might want to look into reverse mortgage as a retired couple. So what makes you eligible? So you're 55 years old, you live in major urban centers, your home is in your primary residence, so you have at least lived there for 6 months and you live there continuously for 6 months of the calendar year. All the title holders of the residence apply as a joint holder, so like as a couple, both of you. The residence is owner occupied and not a secondary home or a cottage. The home is detached, semi-detached, condo or a townhouse. These are the eligibility criteria. So how does a reverse mortgage work? This is important. You don't lose the access to your own house. You just take money against that, which is paid back when you pass away or you sell the house. So you continue to own and live in your house. You will never be forced to move or sell your property as long as you live there for at least 6 months a year. You keep your residence in good order, so maintenance and stuff. You remain current with your property tax payments and you adhere to the loan terms. You can use reverse mortgage for things like paying off a debt, covering everyday expenses, making renovations, supporting your family, paying for in-home care. So reverse mortgage, the interest is calculated on the outstanding balance of both principal and interest throughout the life of the loan. The outstanding balance will increase over time. So if you start getting a monthly amount, that monthly amount will start creating interest. So let's say you withdrew $150,000 in the next 30 years, and now like the person who has taken that is no more. So that 150,000 cash plus interest on that, let's say 50,000, 200,000 will be owed. That will be taken from the estate. Your reverse mortgage must be repaid when the last remaining homeowner leaves the home, which generally happens through sale of property or through death, where the proceeds are used to pay back the loan. Second mortgage is you already have a house, you want to buy a second house, you can access home equity in your house and buy the second one. So second mortgage refers to additional financing that would be in second priority to the already registered mortgage on the same property. You may also think of second mortgage as an additional mortgage on a different property like a rental home or a cottage. In this case, you can apply for a new mortgage for your second property. A second mortgage can be used in different situations. Common reason is you want to consolidate debt, so you take a second mortgage. It's like a home line of credit in that case. So a second mortgage can be used to pay off high interest debts like credit card, so you can focus on paying back a single loan. You need to borrow for a major purchase, child's education, renovation, etc. You want to buy a second property. Most of the time it's used for that. People take on second mortgages, access home equities so that they can buy a second property, a vacation home or a investment property. So that is it for today's class. So please subscribe and activate the notifications if you're watching it on YouTube. If you are not watching it on YouTube, this course is also available on Udemy and Skillshare. So the links are in the description. The complete course is available on Udemy. So it has a lot of additional videos. Okay. So thank you for listening. See you in the next recording.